In this part of the lecture, I would like to briefly talk about empirical evidence, something interesting about IPOs, initial public offering, meaning a company sells shares of stock for the very first time. What happens at that point? First, IPO means selling shares for the first time, and that would be common for firms which came up with some new business idea. They may not have enough peers in the market that are involved in similar type of business. So it might be difficult to price an IPO, meaning it might be difficult for an underwriter to determine what the best price per share should be when they are first offered to the public. We also can say that companies selling their shares have more what is known as asymmetric information. In other words, they know more about how much they're worth, what their product is, what their future plans are for their business than the rest of the public. Underwriters, when they are involved in assisting companies in selling shares in the IPO market, they want to make sure that on average their clients earn a good return. What does it mean? It means that underwriters kind of purposefully underprice shares of stock in the IPO process. So they are selling them on day one at a price that they believe is lower than it should be for that kind of company. Who benefits, who loses from this? New shareholders, investors who will be buying those shares, obviously benefit because they're buying the shares for cheap. But any existing shareholders would be hurt because they're missing out on some money for per each share. And in a way, this is an indirect cost of issuing new securities for the company because it's missing out financially on potentially a lot of money. Here's an interesting graph. So this is an actual data starting 1960 going through 2013, so a 53-year period. You see a lot of little columns here. There's one column for each month of each year. What does the height of each column show? It shows on average across all companies that went through an IPO during that month. In other words, across all companies that sold shares of stock for the very first time during that month. On average, how the price per share changed from day one, the IPO day, and one day after that. So it shows an average one-day return, first day return for all companies that did an IPO during each calendar month during that 53-year time period. What is immediately obvious? It's immediately obvious that pretty much all of these columns are going up rather than down. So what's the line, sort of the starting point for each column? It's the zero line. That's the 0% one-day return, meaning the day a share is sold, it's sold for the same price that you see the day after. If a column is above zero, it means the day after the IPO, the share price went up. If the column is under the zero line, it means the day after an IPO, the share price went down. Share price going down was something unusual. Most of the time, the price would go up, which is what the tall columns line above the zero line tell us. And this is the empirical evidence from real data from this country that the underpricing does exist. Now, it looks like all those lucky people who bought all those underpriced shares can gain so much money overnight. That's true, right? But in a way, that's the whole point. Underwriters want to generate interest in the shares for a company that is selling them for the very first time. What about the companies that selling the shares for the first time? Obviously, it's the opposite story, right? The other way around. They may lose millions or even billions. During the peak of IPOs in 1999-2000, when a lot of internet companies were booming and going public, there were about 900 companies that went public during those years in this country. Altogether, if you take the change in price per share from day one to day two, right, multiply by the number of shares, and then times all those companies that did the IPO, you would see that altogether those companies missed out on about $63 billion because of that underpricing. Why does the underpricing exist? Like I already mentioned, you kind of want investors to have interest in buying the shares of stock from companies that are relatively new, relatively young, maybe little known. You want to kind of attract them with a sort of discounted price, right? The second theory is it's a way that investment banks or the underwriters reward institutional investors for gathering their opinions about a suitable price. So when the underwriters are working on determining the right way to sell the shares of stock for the company on the company's behalf to the general public, they may be sort of surveying other companies or big investors regarding what they think about the suitable price for this IPO. And as a reward, they sell the shares at such discounted price.